Welcome class to our part 2 having to do with self-employment and chapter 7 of our textbook. This little complication is the calculation of self-employment tax, and probably nothing that gives us more headaches as professionals than the self-employment tax, because that is what a typical small business owner doesn't realize that they have to pay. That's because most of us are used to having Social Security taxes taken out at by our employer at the W-2 level or at our every check, and so we're really not in tune with just how much self-employment tax is, which is 15.3% of your self-employment earnings. So we'll go by through a couple ways that this comes up and how it works. So remember our definition of what constitutes self-employment income earlier. It becomes very important because that is what is subject to this tax. So net earnings from self-employment is 92.35%. So first step, no matter what, is to multiply your whatever source of income is by 0.9235, which is basically 100% minus the 7.65, half of the self-employment tax, the part that is actually paid by the employer. So in this case, as a sole proprietor, you are the employer and the employee, so that's why it seems to hurt so much, because you don't typically see how much your employer pays on top of what they pay you in terms of Social Security. So this way you have to pay both of them, and so that's why you first multiply by 0.9235, and you have to pay the full 15.3% up to 127,200 of earnings in a given year. The rest of it, you notice these two add together to 15.3. The 2.9, it has no limit, so it goes on despite no matter how much income you have. So there's a limit on the one part, not on the other. Together, these are referred to as the self-employment tax. So example, self-employed, net profit 145,000. First step, always multiply by 0.9235. Then we are over the limit, so we only charge the 12.4% on 127, or the Social Security part on 127.2, and then on all of it we charge 2.9. Now another way to calculate this is to do the 15.3 on this amount, the 127.2, and then take the difference, 6,708, and multiply it by the 2.9 and then add it together. It'll get you exactly the same place. So it just depends on how you best want to look at it. So that's how you get self-employment tax. Then you get a 4 AGI deduction on page 1 of your 1040 called 1/2 of your self-employment tax. So you take that, divide by 2, easy, 98.28 is a deduction. So that's kind of like, yes, you have to pay both the employee and the employer share, but you get to deduct the employer share. All right, where it gets a little more complicated is if you have earnings elsewhere other than your self-employment or other than your business. So Leslie has income from her job, 40,200, and there her employer has already withheld Social Security taxes. So because she's already paid Social Security on the 40,200, she only has to be taxed on another 87,000 up to the limit at the 12.4%. So when she sets up her business, makes earnings, they're 105 multiplied by 0.9235, just as usual, and you get 968. That's more than what she should have to pay the higher tax on. So she's going to pay 12.4 on up to the 87 or 87,000 The rest, the whole thing is up subject to the 2.9, all 96,968. 2.9. So again, she could take the 87 times 15.3 and then the difference between these two numbers here and multiply by 2.9 and add them together, get the same result. Still, half of it is deductible. Doesn't matter how you calculate it, half of it is deductible for AGI on Form 1040. The whole thing is calculated on appropriately Schedule SE for self-employment. That's how you remember that. Okay, first part of it means that you're going to determine whether you can use the short form or the long form. If you only have a business and you don't have other forms of income that are taxed, then you can use the short form. If you have several forms, then you're going to have to use the long form. So fairly straightforward. It shows you, walks you through multiplying by 0.9235 we already talked about, walks you through getting the right amount if you're up to a limit, and also walks you through and tells you what half of it is and tells you where to put that on the 1040. Important note, you don't have to do this if you're self-employed. After you multiply by 0.9235, if it's less than 400, you can stop. You don't have to do self-employment tax. Well, wow, $400, whoop-de-doo. But yeah, that's the limit. That, again, hasn't changed in decades, so $400 might have actually been worth something at some point, but it isn't much worth it anymore, but it's still the limit. All right, this tax is calculated. The backside is if it's more complicated and you have income from jobs and other things that need to be considered. Bottom part is actually for a special way to do it under farm scenario, but we won't discuss that. All right, retirement plans, a little bit for self-employed, sole proprietors. So you have a Schedule C, you have a business, you can contribute to your own retirement plan. You don't deduct your contribution for your contributions on Schedule C. You put it on Form 1040 on page 1. So you could make the contribution out of the business, but the actual deduction is taken somewhere else. If you provide it for your retirement plans for your qualified employees, which may be required depending on which plan you choose, the amount for the employees is put on the Schedule C. Okay? So on behalf of employees on the Schedule C, for yourself is on the 1040. These are the types of plans. KEOs are not that popular because you'll see they have a lot more work than the SEP plans, which is simplified employee pensions, and the simple plans, which the goal was to make them simple, but I would argue that they probably made them a little more complicated than they needed to. So there's your basic three choices. KEO, notice, has to be established before the end of the year, has to be in writing. You get the maximum is $54,000 you can put in for yourself, or 25% of compensation, and they have to be made by the due date. So there's your requirements. Plan to start for the end of the year sometimes trips people up. How do you calculate compensation for your self-employed? Well, first of all, you take self-employment net profit off the Schedule C, subtract your deductions, then you subtract your deduction for the employee share of self-employment tax. That's that 1/2 that you're going to carry over to the 1040, and then you have to subtract the contribution to get your compensation. Well, the taxpayer's contribution is a percentage of compensation, but at the same time, that contribution is used to calculate compensation. So how do you do that? You have to use some lovely algebraic terms and reorder things in order to make this calculation work. So example, Schedule C, 50,000, contributes 25% to his KEO, and this applies to any of the three plans, whatever percentage, okay? So first of all, you multiply by 0.9235. Self-employment tax is then calculated at $7,065. So his deduction for AGI is $3,532. All right. So that's nothing new. So, but your contribution, Ned's contribution is 25% times his original profit minus this deduction minus this contribution, which we don't know yet. So if you put this in algebraic terms, you reorder the things, you multiply by 4, because this is 1/4, 25%, multiply by 4, then reorder everything, you get C equals 9294, okay? So it requires you to, it's not going to be just 50,000 times 15%, or 25% in this case. It's going to be less than that because of those other deductions that you have to consider. Okay, SEP has a similar maximum. All right, you have a due date of return to put money in, but SEP plans make it so that you have to put in for all your employees too, if you have any. All right, same kind of concept in terms of how you calculate how much you can put in. Start with your 80,000, multiply 92.35%. Okay, figure out your self-employment tax, take half of it. All right, your 80,000 minus the half, minus C, use the percentage you use for everybody else, 20%. Do your algebra, rearrange the terms, and get 12,391. Okay, basically with a SEP plan, every employee sets up an IRA. The employer just makes contributions to their IRA. Everybody participates. If you're full-time, over 21, worked for 3 of the last 5 years, and receive at least $600. That's not very much money. Contribution, written allocation format, can't discriminate, can't give more to one than to others. Everybody has to get the same, and the employees can pull that money out at any time if they leave your employment. So there is no what is called vesting. They are fully vested in that money. If they leave, it leaves. So it goes with them. Simple plans. Notice the maximum contribution is much less than what we talked about in the other two. All right, so it can only be up to 12,500. They can't put extra if they're over 50. You have to do some matching of employee contributions, and there's some specific rules about how that happens, but the simple plan allows the employer and the employee to make contributions. The SEP plan, only the employer can make contributions. But you can't have this if you're a big company. All right, it can be the only one you do, and you have to cover everybody that made at least $5,000, and you expect to make $5,000, which is a little higher than the SEP plan was $600, but still not a lot of money. Pretty part-time folks are going to make $5,000, so you're end up covering a lot of folks if you have employees, most everybody.